Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to follow up with a session that I hosted 2 weeks ago on a paper trading session with Options Play, showing you how you can utilize the tool to track some trades that you want to make. And today, what we're going to do is we're actually going to take some time and review the trades that we have made. The trades themselves were somewhat inconsequential as far as what we made, but what we want to take a look at is how they perform so that we can learn a little bit about the various strategies that we put on for the various outlooks that we have and understand when or which strategies perform the best, what strategies underperformed. This way, you can really get a better sense for how these strategies can be utilized in your portfolio. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll actually start off just like we did a couple of weeks ago with a broader market update, just to give you a sense for where we currently sit in the broader market. Then we'll take a look at some of the bullish and bearish ideas that we presented here a couple of weeks ago, show you how we place those paper trades within Options Play. And then what we're really going to spend some time on is the trade management piece. We're basically doing a review of the trades that we made from 2 weeks ago, which was on February 25th. We're going to take a look at how those trades have performed and take a look at a review of those particular trades. It's going to provide us some insights into the next time you have a bullish or bearish view, what strategies you might select in your portfolio to leverage from an options trading perspective. Now, the primary thing that I want to help investors answer from today or to walk away from today's session is really a review of open paper trades that we made from 2 weeks ago and just discuss each outcome so that you have a better understanding. The next time you're trying to place a trade, how do you go about selecting the optimal option strategy for the views that you have in the broader markets? So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I'm going to share with you how I'm going to review these paper trades so that one, you know how to place these paper trades, and number two, you have some better insights into managing and understanding these trades as you place them in your own portfolio. Now, before I jump into today's session, how many of you were here 2 weeks ago when we placed those paper trades together? Please type 1 into the chat window if you were there for that session, and please type 2 if you were not there for that session. Okay, I see a lot of 1s. I also see quite a few 2s. So for those of you that replied 2, what we're going to do is I'll give you a quick review of what we did 2 weeks ago. I'll show you how to place those paper trades, and then we're going to basically fast forward 2 weeks and see where we currently stand. So right now, the S&P 500 is back near all-time highs, which is a pretty strong reversal from the end of last week when things started to look a little bit ugly. The NASDAQ 100 index was starting to sell off pretty heavily. A lot of the high beta tech names were seeing quite a bit of margin compression, multiple compression here. The S&P 500 broke below the 380 level, which was a support level. Things started to get really ugly, but we've bounced back very, very quickly. Not too different from what we saw here about a month ago when things started to get a little ugly and immediately bounced back higher here. Now, we did bounce higher back to the all-time highs, but intraday today, despite making a new all-time high, the close here is just short of that all-time high. So failing a little bit here on making that new all-time high. So until it breaks above that all-time high, I would be hesitant on calling this back into bullish territory in terms of where we are in the broader markets. But the S&P 500 back to all-time highs certainly is constructive here for potentially turning back into a bullish state for the broader markets. But when we look at the NASDAQ 100 index, not so strong. Now, we did have a failed head and shoulders formation. As you can see, that's the head and shoulders formation. If you project a head and shoulders formation down, that would have projected us down into the 280 5,290 level here to the downside. We didn't get there. It's managed to break back above the neckline. That in itself is considered a fairly bullish pattern when you have a head and shoulders pattern that does not complete. It breaks back above that neckline, and we've broken now back above the 21-day moving average, which, as you can see, this moving average has provided a fairly large amount of support through the way up. A little bit of resistance here on the way down, and now we've broken back above this level. So if we can close above this level and tomorrow close above this level, that certainly puts us much more into a neutral view here for the QQQ, with 324 as the remaining resistance level that it has to get back above. And if it does, we would expect it to revisit the 335 level here to the upside. But depending on how interest rates play out here over the next few days, that might put a bit of a cap here. It might be quite tough for it to get back to 340. But what's really interesting is this fact that small caps are now leading this market higher. The Dow Jones Industrial Index and small caps are leading the markets higher. I don't think most investors would have thought we'd be in this place even a month ago, where it was really high growth, high beta tech names leading the markets higher, the QQQs. Even though small caps have been pretty strong, I don't think most investors would have seen that we would have had a strong reversal where we've had tech still down 5-6% from the peak, while NASDAQ, while the IWM, the Russell 2000, and the Dow Jones making new all-time highs. But that is where we sit, and this is really this rotation that we've seen into small caps, rotation into value that actually has continued, that has found some legs on the back of this rising interest rate environment. So that's where we currently sit from a broad market perspective. You have a fair amount of rotation, which is healthy for a market rally. You want to see rotation out of big caps into small caps, rotation within the sectors. When you see that, that leads us to believe that the health of the market rally is still intact. When you see just one or two segments of the market or one or two sectors of the market leading the markets higher without that rotation, that's when we start to be concerned about a market top. That's what we saw back in January and February of 2020, is we saw technology and consumer discretionary and large cap drive the markets higher, and there was no rotation whatsoever. Here, we're not seeing that. We're seeing quite a bit of rotation, which leads me to believe that there is further upside here for equities, especially if we see perhaps small caps leading that way higher. So what we discussed here 2 weeks ago were effectively three strategies. We wanted to just take some ideas that we had in the broader markets. At the time, things were starting to look a little weaker, so we took some short positions. We also took some long positions. Things have had a pretty strong reversal here over the past couple of days, so we're going to take a look at how they would have played out. But we looked at three strategies. We looked at buying calls and puts when you have a bullish view. We looked at buying debit spreads when you have a bullish or bearish view. And we looked at selling credit spreads when you have a bullish or bearish view. And we did a quick review of each one. I'm not going to go through the details of each one because we do have separate webinars, and you can go back and watch the recording from 2 weeks ago. But what we talked about not only are the strategies themselves, but how do you go about managing them? How do you decide when it's time to take profits, when it's time to cut your losses? We talked about the rules around managing a long call or a debit spread are roughly the same. Long calls and puts and debit spreads are roughly the same. You want to cut your losses when you've lost 50% of what you paid for the premium, and you want to take profits when you've made 75 to 100% of the premium that you have paid. So we're going to go through some of our examples here today and see if any of these have triggered and whether it's time to take profits or cut losses on some of our trades. And then we also talked about credit spreads. Credit spreads gets a little bit more involved in terms of the rules. There are three possible triggers to get out of a credit spread, unlike the debit spreads and the long calls or puts where there's only two rules. Basically, you want to take profits if you reach 50% of the max gain. You want to cut losses if you've lost 100% of the max gain, or if you reach 21 days to expiration without triggering your stop loss or your take profit, it's also time to get out of your credit spread. Now, I don't think we're quite at 21 days yet, but we may have triggered one of these two take profit or stop losses on some of these trades. So we're going to review our trades here as well and see where we currently stand on that front. but we had 3 trade ideas. We had Tesla, we had Facebook, and we had Uber that we went through. So a few weeks ago, markets were starting to roll over here. We were talking about the fact that Tesla had already been rejected the 21-day moving average once, and we were looking for a continuation lower here. We entered this trade here on the 25th, where that red arrow is. And since then, the stock moved substantially lower, but within the last couple of days have rallied substantially. So we're going to take a look at where we currently stand. I will also show you some tools that we have that can allow you to understand how it would have performed during that sell-off here. But Tesla, we took 4 different trades on this particular trade. We bought one, a very short dated out of the money put. This is meant to represent kind of the type of trading volume we see a lot from retail investors these days. Very short dated, very far out of the money puts, because at the time Tesla was trading around 685 or so when we bought this. So we looked at buying in April 685, and at the money put that expired a little over a month later. We looked at buying a put vertical, a 685 500 put vertical, where we bought the 685 puts and sold the 500 puts against that. That was what we would consider a fairly standard put vertical. And we got all the way down to about 530 or so to the downside. A lot of investors say 500 seems too far, but notice how we went from 685 to just 540 or so within a few trading days. So that's why we take these wider spreads. And lastly, we sold the 685 800 call vertical, a credit spread. So these are the 4 trades that we traded, and we're going to take a look at how these trades have performed. Now, for those of you that log into Options Play, I've created these trades so that you guys can follow us along on these trades. So when you go to your portfolio tool, you'll see the 3 Facebook trades, the 4 Tesla trades, and the 3 Uber trades. So we're going to focus on the 4 Tesla trades first. Now, I just want to remind investors who missed our session here from a couple of weeks ago, just to give you a quick review. If you are looking at a trade and you're thinking about placing the trade and you're not quite sure and you want to learn more, especially for those of you that are new, or if you're trying out a strategy for the first time, let's use I don't know, I'm going to use a boring utility stock for 1 second. Let's say you want to try out a new strategy. You've never traded it before, but you're trying it out. Maybe you've never traded a vertical before. We have a paper trading tool that allows you to effectively save a trade and watch it throughout the life cycle of that trade. And what you do is, for any trade that you want to follow, let's say you've never traded a vertical before, this is your first time trading a vertical, and you want to follow this trade that I have here on the right-hand side. What you can do is you can click on this blue you can click on this blue share arrow for any trade that you want to follow. When you click on that, you're going to have a link here that's under the Options Play score that's called Save Trade or Copy to Clipboard. When you click on that, what that does is it copies this trade and saves the trade in your profile. When you click on that, what happens is we basically save the trade. We'll take a snapshot image of the trade, and we'll give you 2 links, one for the image for the trade and one for a link that you can share to other people. You can share it on social media, you can save it, whatever it is that you want to do with that trade, especially if you want to maybe run the trade by a friend, you can do that using this share feature. And once you save a trade, all of these trades will live in your profile. You can go to your name on the upper right-hand corner, click on your profile, and there's going to be a section here called Shared Trades. When you click on Shared Trades, what that's going to bring you are a list of all of the trades that you have saved. So as you can see, the 4 Tesla trades from a few weeks ago is here. The few Facebook trades that we made, the Uber trades that we've made, they're all here. And you can click on the trade itself. So if we go to our March 12th 600 put, this is that really short dated out of the money put, because Tesla was trading at 685 at the time. This was trading at 600. This was a strike price pretty far out of the money, the $60 puts. When I click on that trade, what it will bring up is the trade within Options Play. And the share trade feature is designed so that even if you share it with a friend who doesn't have Options Play, they'll be able to at least look at the trade. They won't be able to modify it or use the platform, but they can at least look at the trade that you've sent them. So in this particular case, At the time, just so we're clear, the trade that we made was we bought the March 12th $600 puts. We paid $1,750 for those out of the money puts that were expiring in about 2 weeks' time. Today, that option is worth only 33 cents. So we paid $17.65. It's now only worth 33 cents. So we've lost $1,710 on this particular trade. Now, some investors will say, well, this trade would have been in the money a few days ago. We would have lost that money over the past couple of days. And that's true. And that's exactly what I'll try to go through a little bit in terms of helping you understand how this trade would have done over the past few days if you maybe got out of it back here on March 5th or March 4th or March 5th or March 8th, what that would have looked like. So we'll take a look at that here together using the Thinkorswim platform. But this is really how you can utilize the options play tool to find, to place a paper trade and be able to go into your profile and look at that trade throughout the life of that trade and see how it's tracking day by day. Now, what I've done is I've created this, I've also created these trades into our portfolio so that we can follow it along in our portfolio. So just to show you how these trades currently sit. So we have these 4 trades. So we bought the out of the money put, the short dated out of the money put, that's the one where we bought for $17.65 and now it's trading at 30 cents. So we've lost $1,735 or 98% of the premium that we pay. I'm going to show you how this trade was actually up about 200% just a few days ago, and we've lost all of that and the $1,700 in just 2 days effectively. So that's the risk that you take with these really short dated options, is you can make a lot of money, but you can also lose a lot of money within just a day or two. And that's exactly what we're seeing here with that short dated option. Now, if you bought just an outright put, this is the simple option strategy. So we bought the April 685 puts. So this was the at the money put expiring roughly 45 days from the time that we purchased it. We purchased it for $77 for that put option. It's now worth $59.20, which means that we've lost roughly the same amount of money, but it's only 23% of our investment. So we've lost roughly the same amount than if we had traded that out of the money put option, but we invested a lot more. We invested $7,700 and we've lost $1,700 or roughly 23%. So then let's take a look at the put vertical here. The put vertical would have cost us less money because instead of costing us $7,710, because when we buy the vertical, we pay the $77.10, but we collected the $16 to sell the $500 put. So our net cost on that trade was only $61, but that trade is still down to $49. So we've lost $1,200 or 20% of our investment. So obviously, if we think the stock is going to go lower here, which, whoops, this is Con Edison. Let's go to Tesla real quick. We initiated the trade here on the 25th. We initiated the trade here on the 25th, which is this particular candle. Now, after we initiated the trade, the stock moved a little bit higher for a few days, fell apart for about 5 days, but quickly rebounded here over the past couple of days. Now, when this type of price action happens, because when we entered the trade, the stock was at 685 and the stock is now at 699. Any bearish trade, they're going to lose money, right? If you think that the stock's going to go lower, but the stock moves higher instead, your bearish trade, no matter what type of bearish trade, is likely going to lose money. But I will say, as you can see here, the last trade that we made was a credit spread. The credit spread is a far more forgiving strategy. For those of you that follow us here on the Daily Play, we've been trading a lot of credit spreads because the higher interest rate, higher volatility environment favors selling strategies. But this is one where, because we entered the trade when it was 685 and it's now at 699, it's about $15 higher. We sold this credit spread for $41.40. It is now trading at $44, which means that we've lost about $260 out of our $4,000 max profit here. So we've only lost here about 6%. So as you can see, this is an example of a trade that didn't go in the direction that we expected to, at least if we held it to today. And we'll take a look at, what would happen if, let's say, we got out of this on March 5th or March 8th. I'll take a look at that in 1 second. But as you can see here, if the trade doesn't quite work out, if you bought a put option, if you bought an out of the money put option or a short dated put option, you would have lost pretty much everything. If you bought a put, you would have lost a decent amount of money, but not a whole lot. And especially an at the money put, especially when you still have 36 days to go. And this is why we advocate when you're buying puts, go slightly longer, because this way you're not losing 98% of your investment. Here you're losing 23% of your investment. And we talk about buying a put spread, which reduces your risk, right? So instead of risking $7,700, I'm only risking $6,100. So I'm risking roughly, in this particular case, 8 or 9% lower. And what it means is that I'm also going to lose less in terms of my percentage here. Instead of losing 23% on just a straight put, I'm only losing 20% on my put vertical here. And the credit spread here on the right hand side, even if I get the direction slightly wrong, I really have relatively small losses. Only if Tesla was to rise substantially will I see some substantial losses here from the credit spread. And when we look at Facebook, it'll become a little bit more obvious here. So those are the 3 trades that we made, and that just gives you a sense for how these different strategies would have played out. So I just want to do a quick poll here. If you were in this trade at the time, which trade would you have made? Would you have bought the put, let's just call this number 1. Let's call this number 1, which is the short dated option. Number 2, the vertical spread. 3, the long put, or 4, the credit spread. Why don't we ask a quick poll? Which one of these would you have traded? 1, 2, 3, or 4? Okay, I see a lot of 4s. I see a lot of 2s, which are the debit spreads. I pretty much see 2s and 4s. Interestingly enough, I don't see a lot of 1s. Okay, here's an honest answer. Christo said the old me would have bought 1, the out of the money short dated put option here, and that's And I do want to show you guys one thing about that short dated option, just how volatile this is. This is, what Wall Street Bets calls YOLO. You only live once. So, and let me just show you this to show you what that looks like. So here's the Thinkorswim platform. And I'm bringing up the Thinkorswim platform because it has a feature called Think Back, which is under the Analyze tab. So under the Analyze tab, there's a thing called Think Back, which allows you to basically say, what happens if I did something prior? So what I did is I went back to the March 12th. First of all, I put it so that this is on February 25th. That's the day that we placed this trade. So on February 25th, I went back to the March 12th $600 call option, which at the time was trading about 17.65. So the mid price was 17.35. That's the price that we executed at. And what this will show you is how that trade would have performed since February 5th on. So as you can see, you have 2 lines. You have your the candlestick chart for Tesla, and then you have this orange or gold line that represents the P&L of one contract of this March 12th $600 put option. And you have your price of Tesla here on the right-hand scale, and then you have your P&L scale on the left-hand side. So as you can see, on March 25th, when I got into the trade, that's when I would have been flat. The very next day, I would have been down about $500 or so on this particular trade. By day 2, I would have been down about, in this particular case, down about $1,200. So you paid $1,735. By day 2, you would have been down $1,200 already. So this is really where most investors would probably bail or say, you know what, not sure if this is something I want to hold on to. But many times when you've already lost that much, most investors just hold on to it anyway because they're thinking to themselves, well, I could only lose another few $100. Why not just hold on to it? And that is something that we realistically see happen. And then as you can see, after that, when Tesla had that big 5-day sell-off here, this trade went from down $1,200 to down roughly $1,000 to up to down about $300 to up about no, I'm sorry, down $300 to up $300 to up almost $1,300. And at the peak here on March 8th, if this trader held this trade down to the bottom, this trade would have been profitable by about $3,000. So the $1,700 trade that $1,700 that you've risked, you would have made $3,000 if you had closed it out at the end of March 8th. But I always tend to find that these trades, it's easy in hindsight to say, well, if you had closed it at the bottom, you would have made this much and that would have been great. But many times we see these types of investors will hold on to these types of trades because the very next day, going from $3,000, a little over $3,000 in profits to down about $1,300 in losses. So that's how big of a swing you'll see in a single day with trades that go like this. And this is what we refer to as gamma risk. So you may have heard me talk about gamma risk, right? Especially when we say never sell short dated options because of gamma risk. This is what we're referring to in terms of being short that gamma risk, meaning as you get closer and closer to expiration, the swings in the price of an option get larger, meaning you can go from big gains to big losses within just a single day. And that's exactly what we see get exacerbated as you get closer and closer to expiration, especially if you're near the strike prices around the expiration. That's exactly what we saw, because a few days from expiration, a week from expiration, the stock was at $596. Remember, this is a $600 put option. So we're just $4 shy of the at the money price. One day later, we're down to $563. So we're about 30, 40 bucks in the money. And the very next day, we swing to $70 out of the money. So that's how you go from these huge swings of being up $3,000 on a trade to being down $1,300 on that particular trade. So this is not to say don't buy out of the money call options or put options, especially short dated ones. Occasionally there are some rare scenarios where I think it's worth doing, but this hopefully shows you what type of risk you're taking when you do that type of trade. At the end of the day, we all have different risk tolerances. Some of us have very high risk tolerances and want to place these types of trades. By all means, just as long as you understand what or how these options react around around expiration and what type of additional risk that you start to take as you get closer and closer to expiration. Okay, so now, that's just a quick feature, and this allows you to type in, this allows you to use any type of trade that you make. You can even do multi-leg trades. So on that day, if let's say we traded that spread that I was talking about, where we bought the 685 puts and sold the 500 puts, we can also see how that strategy would have performed during that same time. As you can see, it's not too different. When we entered this trade was down a little bit. It got down to about close down to $2,000 we would have lost. So, remember, this is a trade that we paid about $7,100 for that particular trade. I'm sorry, $6,100 for that trade. You would have lost about close to $2,000 2 days into that trade. So we would not have triggered that 50% rule, right? Because you would have to lose roughly $3,000 to trigger that 50% stop loss. And at the peak on March 8th, this got as high as about $4,500, just shy of $5,000 in profits, which would have actually triggered our take profit levels here. So this is a trade that we would have potentially taken profits here on this particular day if we had entered this particular trade, because at $6,000, so just to put that into context, we risked about $6,100 on that particular trade. 1.75, which is the threshold of which we would have taken profits, would have been 1,675 minus 10,675 minus 6,100. If we made a $4,500 profit, it would have been time to start taking profits. And that's exactly where we touched roughly at the peak here. We would have made just a little over $4,700 in profits on that particular date. It's 4,805 actually on that particular date. And just to show you where that is, that's this number right here. Whoops. Yeah, as you can see, whoops. See how there's a Think P&L number right there as you move your mouse over? That's 48.50. So we would have just squeaked by the threshold of when we would have taken profits on this particular trade on the vertical spread. And we can also say, well, what if we didn't buy that? What if we didn't trade the short leg? How much gain will we have had? We had a 6622 in terms of P&L here on just the straight put leg. So if we just bought the April 685 puts, on March 8th, this would have looked at about a $6,600. I don't know why it keeps doing that. So sorry, I apologize. But this is the number that I'm referring to that shows up right there. As you can see, that's a 6622. So if we risked $7,700 and we made 6622 in terms of P&L, that would have met our threshold for taking profits. And just to reiterate where we take profits on debit spreads at 75 to 100% of the premium that we have paid, we would have taken profits. So despite the fact that all three Tesla trades right now, as you can see, a 98% loss, 20% loss, 23% loss, even though that's where they are now, in theory, on March 8th, we should have looked at this and said, we've reached our take profit thresholds, and we would have taken profits on March 8th. So when the market bounced back the very next day, we actually would not be suffering the losses that we're currently seeing here today. So hopefully this is a good lesson and just showing you how important it is to monitor your positions on a daily basis, because things can change very, very quickly. We managed to reach our take profit levels. If we took them, we would not be in the position right where we are. But the credit spread here, and just to take a look at that credit spread, the April 9th, 685, 800 call vertical. Let's look at what that would have looked like. April 9th, we sold the 685. We bought the 800s. For that, we collected, what was it? We collected 4140. So we would have had to make about $2,000 profit on that, which to reach our 50% of max gain. So max gain is $4,100. If we can make half of that, we want to take profit. So let's take a look at how this trade would have played out here. At the peak here, we would have made $29.75. So as you can see, that's this P&L number here, $29.75 on March 8th. So we would have also met our thresholds to take profits on our credit spread as well. So this is hopefully giving you some insights into how you can utilize the options play tool in conjunction with something like Thinkorswim to really dive into some of these trades, especially if you want a paper trade, especially want to go back and see how would I have performed. This is a great way to go about doing so. So let's take a look at the other trades that we made. Facebook, we were also bearish on. We entered it pretty much at the market bottom. So this was a pretty poor entry. At the time, our thought process was that that was the first day that Facebook broke below the 200-day moving average. It looked like it was pretty heavy here as we continue to make lower lows, lower highs, and it broke below that 200-day moving average, that it was going to continue moving lower. And that's not exactly what we got. We got exactly the exact opposite. We bought the 255 puts for May. We bought the May 255, 205 put vertical, and we sold the April 9th, 255, 280 call vertical. So all three of these trades are pretty much at its stop loss levels here. As you can see, if you had bought just the straight put, you would have been down about 49%. If you bought the put vertical, you would have been down 46%. So both of these are pretty much at the thresholds to take to cut losses, because again, on a debit spread or a long put, we want to exit at a loss at 50% of the premium paid. Now, a lot of investors ask, why do you want to cut losses at 50% of the premium paid? And the answer is really because once you get to this point where you lost about 50% of what you paid on a debit, so whether it's a long call, long put, or debit spread, you're going to be able to, the chances of this getting back to break even is usually only about 20 to 30%. What that means is that 70 to 80% of the time, you're going to lose the other half of the premium. it's better off in the long run for you to simply take the other half, apply it to your next trade, which you have a higher chance of making money on, rather than trying to hope that you can get yourself back to break even. Because yes, 20-30% of the time you do get yourself back to break even, but the 70-80% of the time that you don't, you're just going to keep eating away at what is good money that you can use for your next trade. So here's an example where both the debit, the long put and the debit spread have reached effectively our stop loss levels. Our credit spread has not reached that just yet. We sold something for 970. Our stop loss levels are 100% of the max gain. So this has to get up to about $18 or so, $19 or so in order for us to reach our stop loss levels here for Facebook. But here's the thing, the other way you need to look at this is the fact that we traded this when Facebook was making lower highs. It was breaking below major support or resistance levels. You can see the trend quality was turning bearish and it was staying bearish. But as soon as the trend quality turned back into green and it broke above resistance levels, it broke above the 200-day moving average, trend started to turn bullish. That really invalidates the thesis of why we were short Facebook to begin with. So if you continue to hold on to it, you can do it. But at that point, you're just wishing that the stock continues to roll over. The thesis of which you initiated the trade is simply no longer valid. And that always is another reason why you may want to get out of a trade, even if it hasn't hit your stop loss levels just yet. I see too many investors many times just continue to hold on to trades like this, and they just hope that the trade goes back, and they search for other reasons why they should continue holding on to that trade. In my opinion, if your thesis that you originally entered the trade on is no longer true, that's usually a pretty good reason to just cut your losses, move on. And now you're saving more capital, right? You're saving more capital that you could apply to the next trade, a better trade, a trade that is going to potentially play out the way that you want to. Don't sit there and wait and hope that your trade comes back. And lastly, we'll take a look at Uber. This is a trade that did work out quite well. At the time I was saying that, Uber continues to seem to show strong strength here on both the daily and weekly chart. You had a recent pullback here, which I thought was a decent entry opportunity, just like what we saw here. And this was exactly what we got. The stock was around 50, just a little bit high, around 51 at the time. It's now bounced up to about 59, just shy of the $60 level. That's almost a 17-18% rally here in the last 2 weeks that we have gotten together. At the time, we also bought a simple call option, a simple strategy that many of us are familiar with. We bought the call vertical, so just trading that spread, and we also sold that credit spread as well. So let's take a look at those three trades. If we on Uber, right? So because we got the directional view correct, all three trades are profitable. That's a good thing to see. And we've now broken above a resistance level here around 57. Now that I'll talk about that in 1 second. Let's talk about the strategies themselves here first, right? So if I bought just the straight call option, this is really where, because you've had such a big move in such a short amount of time, the straight call certainly will outperform the call vertical here, which tends to underperform a little when you have big, fast moves. So if I bought the $50 call option for $6.85 and then it's now trading at $11, that equates to a 62% gain. So that puts us just shy of the 75% threshold that we would start looking at taking profits on this particular trade. Now, this trade still has a lot of time, still has 71 days to go. So I'm inclined to hold on to this, especially because we've now broken above a resistance level. Right, so you have this resistance level here around 57.90 here. This is automatically calculated for you from options play. We've broken above that level. That level is now support. So my expectation is that I can continue to see Uber expand here to the upside, and the all-time high here is around 64. That would be my next target here to the upside, and I still have plenty of time to go. So I would hold on to this trade, especially since we haven't quite reached our profit levels yet. The vertical spread, we paid $4.94 for it. Now it's it's trading at 770. That's not too far behind. It's only 56%. It's a 56% gain versus a 62% gain. So those two very similar to each other. And the credit spread that we sold a 51.47 put vertical for $1.60. It's now only trading for 35 cents. Remember, our rule of thumb for taking profits on a credit spread is when we reach 50% of the max gain, it's time to take profits. So when our max gain is $160, once we make about 80 bucks, it's time to take profits. So we would have actually taken profits on this particular trade because it's now down to 35 cents. We would have made about $1.25 here on that versus the 80 cents that we're looking to make on a credit spread like this. So this is, on the credit spread side, I would have taken profits already. On the debit and the long call, I would continue to hold on to this trade because we're just not quite near our take profit levels. And this chart looks fairly constructive for a continuation higher here. So this is one that we could potentially continue to monitor and just see when it might be the optimal time to get into the trade. So overall, we had some interesting, we had some successful trades. I would say, Tesla, looking at this, if we were diligent and we were keeping track of our positions on that March 8th low, we would have triggered all of our take profit levels on all four of these positions, even though they're all losing positions right now. So, and notice how quickly things shift from March 8th to March 9th. All of these positions went from big winners to at least a small loser, at the very least, some of these big losers, depending on whether you traded a short dated option or a longer dated option. But if you were diligent, you would have been able to take profits on this trade. Facebook would have been a trade that just, is at that, did not work out, is not going in the direction that we expected to. We're near stop loss levels across all three positions with the exception of the credit spread. But looking at the trade itself, I would say that it's probably time to cut losses anyway. And Uber, this is a good trade, turning out exactly the way we expected to. Depending on which strategy that you would have taken, you would have had different outcomes here. The one thing I will say is that when you expect a big move like Uber, you're better off trying to trade that debit spread or that long call, because as you can see, you're looking at $400 profit or $276 profit versus only $125 profit. So that's really how you go about thinking about debit versus credit spreads. I saw someone else, Clark, who said, when I asked the question, which one of these strategies would you trade before, when I was asking about Tesla, and Clark made a very smart comment. He said, well, I would have need to see the IV rank at the time to decide which one I want to have traded. And I understand the thought process behind that, but I will say, if you only look at IV rank as your deciding factor as to which strategy you trade, you might find yourself underperforming your directional view by a lot. Because, when you expect the stock's going to make a big move, first of all, I would imagine that when Uber would have went down like this, the IV rank would have been pretty high. So a lot of investors would automatically default to selling credit spreads. I see this a lot. When IV rank is high, people just default to selling credit spreads. But, if you expect that the stock's going to make a big move because A, it's in a reopening trade, you see that stimulus is coming out, you see that vaccine rollouts are coming fast and strong, and you're anticipating things are going to outpace the market. Well, despite the fact that IV ranks are high, you don't have to just sell in order because IV rank is high. You can trade spreads, you can trade calendars, you can trade diagonals, you can trade vertical spreads. You don't, that's one of the ways to combat high IV rank as an option buyer. You can offset that high IV rank by buying a debit spread or buying a diagonal spread. Those are ways that you can combat that IV rank. You don't want to just say, I'm going to sell options when IV rank is high and buy options when IV rank is low. If you can only trade one leg at a time, then I would agree with that philosophy or thought process. But when you can trade multiple legs, you don't have to fit that specific mold, because if you just follow that one mold without really thinking about where the stock can go, then you're looking at making only $125 for roughly the same amount of risk than someone who's making $425, 3 times the reward for roughly the same amount of risk. That's how much you can underperform by if you only use IV rank as your deciding factor. So don't use IV rank as the only deciding factor. And it is important to understand how IV rank, how expensive or cheap options are, but there are other ways around it than just simply saying sell when it's high, buy when it's low. So with that, that covers what I wanted to share with you here today. I hope that this was helpful. And number one, reminding you how you can paper trade using options play, giving you some thoughts behind placing these trades and showing you the life cycle of this trade, the difference between buying an option versus selling an option, and when you might want to take profits, when you might want to cut losses, how you want to think through, is this a trade that I'm going to hold, or is this a trade that I'm going to cut my losses or take profits on? So with that, thank you so much for your time here today. And I know I spent some time on Thinkorswim, and there's quite a few questions here on Thinkorswim. So I do want to tell everyone, we have a new partnership with TD Ameritrade and Thinkorswim. So if you want to open up a trading account here at TD Ameritrade that allows you to access the Thinkorswim platform, I've been doing some more videos on Thinkorswim to show you how I use this platform, because this is the platform that I've been trading on since I was 18 years old. I learned how to trade futures on Thinkorswim with Tom Sosnoff. I learned how to trade options on this platform. Thinkorswim is the sponsor on CNBC's Options Action. So we have a new partnership with them. I'm going to be doing more videos going forward to show you guys how I set up my trading platform. And especially, I recently just posted a video on YouTube on how to use Thinkorswim's platform to do OCO orders. A lot of you who trade spreads like I do, you end up spending a lot of time managing those trades. Now, I'm a pretty busy person. I don't really always have time to sit in front of my computer monitoring every single trade and deciding when I'm going to take profits or when I'm cutting losses. And I think the Tesla example is a prime example of why you want to have orders set up, ready to go to take profits on your behalf. Thinkorswim allows you to put what we call OCO bracket orders on a spread. So when it reaches my take profit level, it automatically takes profit and cancels my stop loss. And if it hits my stop loss level, it automatically cancels my take profit level. So I'm basically protected on both sides of the market when I'm trading a spread. And you can do that at Thinkorswim. Not every platform supports that. So I recently posted a video on YouTube for that session on how to do that using the Thinkorswim platform. And hopefully today, I showed you a little bit as far as how you can use the think back feature. Great tool in terms of helping you understand how to utilize the think back features, which allows you to go back and see how a strategy would have performed, and you can kind of see for yourself, did it hit my take profit levels? What I've been able to get out of that trade, or what I've held through a loss here on this trade like that. So with that, thank you so much. At this point, what I'll open this up is for Q&A. There is a chat window and a Q&A session, so please type your questions into the Q&A window, and I'll try to answer as many questions as I have time for here today. Okay, let's take a look at some of the questions. Can we, let's see. So Ray, your question about a few different stocks, come to our rapid fire session tomorrow morning. I'm doing a rapid fire session where you submit your symbols and I look at them, based on the symbols that you submit. So if you have some symbols you want to look at, please submit them for tomorrow morning. Carrie is asking, this is a simple question, but I'm trying to get some clarity on credit spread transactions. In terms of the process, when we buy a credit spread, do we receive the credit to an account? First of all, you sell a credit spread, and yes, when you sell a credit spread, you receive the credit to your account. And to exit the trade, do you buy the credit spread? Yes. So when you exit the trade, that's when you're buying the credit spread, and the difference between the price you sold it at and the price you buy it at, that's your P&L at the end of the trade. Yes, that's correct, Carrie. I sell when I have a little profit because market is moving up and down a lot during this period. Okay, I think that's more of a statement. Elizabeth saying, is it because these trades are only discussed at the options education webinars? I'm not sure I understand the question, Elizabeth. Hi, Tony, where can I find IV rank on options play? So when you go to the trade tab and you type in any symbol, at the very bottom of the options chain, you have this thing called today's option statistics. And on Thinkorswim, it's called IV percentile, but it's actually the IV rank calculation. So as you can see, the IV rank of Apple right now is 15%, and that's how you can find it on Thinkorswim. When to trade a diagonal or credit spread. So Tariq, so I actually have whole sessions on both diagonals and credit spreads. So you can go to our YouTube channel and take a look at some of those videos. Both of them were recorded actually fairly recently. Julie, options play has really helped me with option spreads. I'm really glad to hear that, Julie. Guillermo, can you show how to set up stop loss on options, please? So here, let me share that video with everyone so that you guys can watch that video. 1 second. Okay, so I'm posting a link into the chat window right now. This is the post that I'm referring to that I've recorded recently on the placing a stop loss and a take profit on your Thinkorswim platform. Stop loss and take profit on your Thinkorswim platform in a single order. And that's the key part, is a single order. You don't want to place a stop and you don't want to place a stop and a take profit separately, because you effectively then have two open orders. You want to make sure you put in what's called an OCO order, and one cancels other, because that's way if it triggers your stop loss level and automatically cancels the take profit, and vice versa. Michael saying, hi, Tony, thanks for your insight. A couple of questions. One, when do you buy a simple call or put option? How many days out do you typically go? Michael, so that's actually in this presentation. So when you review this with the slides, you'll be able to see when you're buying calls or puts roughly 60 days out, and you want to buy a 50 delta call or a put as a starting point. For these types of trades, is your profit level still 75%? That's also covered in this, which is long calls or puts, take profits at about 75 to 100% of the premium paid. Guillermo saying, on Thinkorswim, how would you show, oh, Guillermo, that I've already sent that link to everyone. So I will be able to place trades from options play directly to Thinkorswim. So no, Joe, you won't be able to place trades directly from options play to Thinkorswim, but that is something that we are currently looking into as to how we can make that process as seamless as possible. How do I save a personal watch list? You can go to your watch list. You go to menu, new watch list, but make sure you name it. You have to name your watch list. If you don't name your watch list, it won't save, but name your watch list, type in your symbols, and it will be one of the watch lists that shows up on the drop-down menu. So as you can see, name your watch list is now here. Is it possible to use Thinkorswim if you're an international trader, non-US? Ahmed, that depends on what country you are from. There are plenty of countries that you can open up a Thinkorswim account from, but I don't know whether or not you live in one of those. So you're going to have to contact Thinkorswim, but you can click on that link. Actually, if you click on that link, when you click on open an account, it will, if you go to trade.optionsplay.com/Thinkorswim, it will be in the country dropdown. So when you apply for an account, it'll ask you for your country and it'll tell you immediately whether or not you can open an account. Does the deal with Thinkorswim remove tastytrade? Not at all. I have Tom Sosnoff coming on next Wednesday. So I'm actually doing a very special event here next Thursday. I hope most of you are, I'm sorry, not next Thursday, next Wednesday with Tom Sosnoff. We're going to be talking about small futures products. You know, for those of you that have followed me for a while now, you might know that I started learning how to trade derivatives on the Thinkorswim platform with Tom Sosnoff giving webinars about 14 years ago or so. My first products that I traded were futures. I was a futures trader for quite a few years, very actively. So I'm really excited to be doing the session next Wednesday with Tom, where we're going to introduce small futures. It's a new futures exchange. And what's really interesting about them is that the contract sizes are much smaller. They're all standardized, because one of the most confusing things about futures is the different types of futures products all have different contract sizes. They're not standardized. You know, E-minis are $12.50 a tick. Micros are $2.50 a tick. It's just confusing as to when you're used to trading stocks that tick in 1 cent increments, when you're trading futures. So the small exchange futures are all standardized. They're all small, so they're suitable for traders with small accounts. And trading costs are relatively low, and you get exposure to some very innovative things. And I'm really excited to talk to you guys next Wednesday about this. But no, I'm still going to have Tom on. We're going to continue to do sessions with Tom. We're big supporters of both Thinkorswim and Tastyworks. Calendar spread, what is your profit target to close? So calendar spreads are a little different. Calendar spreads are kind of like short straddles. You would have roughly that same 50% profit target here on a calendar spread than, a debit spread, even though technically it's a debit. What other criteria indicators do you use other than IV rank? So Mark, it's really a factor of technical and fundamental factors that usually drive my investment thesis. IV rank is certainly one thing that I look at, but that's not the primary thing that I use to determine my directional view. My directional view is based on more technical and fundamental factors, relative strength, and just general market conditions. It was hard to follow you on OCO. Is there a way to enlarge the Thinkorswim screen? Michael, here, I'll try to do it right now real quick. Actually, I won't be able to do it because the markets are closed right now. I'll take a look at that video and see if we need to re-record it in a way that's a little larger or easier to see, Michael. What would be a simple protection strategy for SPY as of today? Simple protection strategy would be buying a put option. That would be a simple protection strategy, but really the easiest protection strategy is moving into cash. If you have SPY and you think the market's going to drop, move to cash. That is what we call a perfect hedge. Are your TDs videos on TD or YouTube? They're on YouTube, Les, and I just posted a link in the chat window. But I will be doing some sessions with TD Ameritrade Network soon in the next few weeks, so I'm really looking forward to that. In credit spreads, if the spot price is way higher than legs, in that case, do we still close at 50%? I'm not sure what you mean by the spot price is way higher than legs. Do we still close at 50%? From a credit spreads perspective, where the spot price is somewhat irrelevant from the perspective of you just want to close out at 50% of max gain. Ken is saying at a 50% loss means your probability of recovering your losses is 20-30%. What percentage of losses will correspond to a 50% chance of recovering your losses? Probably somewhere in the 20 to 25% loss. You would probably have about a 50% chance of recovering your losses. I don't have the stats off the top of my head, but that would be my best guess, Ken. On my options play app, I do not have a managed link like in the demo. So Scott, that's something that you don't have access to. That's only admin access that we have access to create those global portfolios. Frank is saying, Tony, I couldn't find the recording on the 225 session. Did it get posted on YouTube? Great question. Let me check. It should have been, but I could be perhaps. Yeah, it was posted. It's right here. I'll post the link into the chat window. If you're referring to the session where we initiated these paper trades, it is on YouTube, and I just posted that into the chat window. Julie, I know Tastyworks is working hard to come to Canada, but I know that they can't come to Canada right now because they can't get up there to take the tests. But I can tell you, Tom definitely wants to be in Canada. If a trade hits target early on and I still see the trade can profit further, what can I do there? Roll or what? If you think the stock can go further, then you can always just hold on to the trade for more gains. But it really just depends on what kind of trade you're referring to, right? If you're talking about a debit spread, I would definitely roll. If you're talking about a credit spread, keep in mind that even if the stock keeps going much further, you're going to make less per dollar, even for that stock to go higher, which is why, generally speaking, on credit spreads, you just want to take your profits and move on to the next trade. Jonathan saying, is there a video on what happens if a stock closes between your buy and sell on a vertical? Jonathan, there is a video. I actually think we just posted it. Give me 1 second. First of all, you should never be in a scenario where the option is about to expire between the vertical spreads, because if you, first of all, you should never hold these to expiration. So you really don't have to be worried about that. But I recently just posted actually, I'm sorry, we haven't posted it yet, but I did create the video where we talk a little bit about how to deal with options that are expiring in between the spreads. But my suggestion is to never hold option strategies to expiration so that you're never put in that position. Deepak is saying, how good are the trade ideas that Options Play displays? Have you ever done any performance analysis on these recommendations? So Deepak, every single day when we send you a trade signal, at the bottom of that email, there's a link that shows you our trade performance. So Deepak, just take a look at that email and you can see every single trade we have ever presented. We'll show you our entry price, our exit price, and the performance of those trades. Hi, Tony. Thinkorswim is not usable by European residents. So, Angelo, I apologize that you cannot open an account for European residents. I wish that they could take, residents from other places. Regarding a Thinkorswim trading account, being an Options Play member, is there a minimum requirement to open? I don't believe there is a minimum requirement. If it is, it's pretty low, probably somewhere in the $200 to $500 range to open an account. How to identify if an option is too expensive? Well, one way is the IV rank. IV rank above 50% is usually a good sign that options are fairly expensive. Is one way that I would do it. For credit spreads, you said sell 50 delta call or put and buy back 25 delta call or put. What does that mean? So Tony, I would recommend that you take a look at, so every single strike price has a delta. So if you can see here, this looks incorrect here. So here on the Options Play tool, let's go back to Apple. The delta just tells you the probability of the strike price being in the money. So if Apple's trading at 120, let's just call it 122, and I'm bullish on Apple, and I'm trying to figure out what strike price do I want to sell on a credit spread. I want to sell roughly the 50 delta here, which is, we have the 125s or the 120s. You don't want to sell an in the money call option. So I would sell the 120s. That's the closest to the 50 delta. I don't want to buy back the 25 delta, which is the 110s. So it's sell the 120, 110s as my strikes for my credit spreads. So the delta, as you can see, that's the third number on your option chain. You have your your strike price, your premium, and your delta. Delta is just the probability of the stock being below 110 at expiration. So when you see a 0.24, that means there's a 24% chance that Apple will be below 110 at expiration. So you always want to choose your strike prices based on a probability-based approach to those strike prices. Christine is saying, I was interested in what you said about not choosing a credit spread versus debit spread based on IVR as a determining factor. However, can we say that credit spreads with high IVR and debit spreads with low IVR have a higher pop? Yes, Christine, that is a true statement. That is an absolutely true statement. But The difference between a debit spread with low IVR in terms of pop and a debit spread with high IVR in terms of pop is no more than a few percentage points. It's not like low IVR is 30% and high IVR is 50%. The difference between high and low IVR is going to be like 33% and 35%. So it's a slight edge, but it's not very much, which is why, again, it should not be the one thing that you use to determine whether you're going to trade a debit or a credit. As you can see here in the Uber example, I think that's probably the best example of just how much the credit spread underperforms the debit spread. You know, when I sold this credit spread here on Uber, let's just go back here real quick. Let's go back to your, so this is the call option. Whoops. Hold on, I don't want that. This is the call option, and this is the credit spread. Okay, so when I bought the call, I risked $685. When I sold the credit spread, I risked $240. So just to put these into context, right, I can trade roughly double the amount of credit spreads to, so if I sold 2 credit spreads, I risked $500. If I sold 3 credit spreads, I would have made, I would have risked about $750. So, you know, it's the two are kind of similar from that perspective. So let's see. So if, let's say I sold 2 contracts of the credit spread instead of 1, because that would have risked about $500. So, okay, let's make this a little, let's just compare these two. Let's compare the verticals, the debit spread versus the credit spread, because I think that's, first of all, a fair comparison, right? So a credit spread, I would have risked about $500. So here I would have traded 2 contracts. So here I would have made $250 in profits by trading 2 contracts. Here I would have made $276. Now, the question is, how much more could I potentially make if Uber keeps going higher here? And in this particular case, I do happen to think that Uber has quite a bit of legs and can continue to move higher, considering that it has broken out above its resistance level. And I'm not even near my take profit level here. I'm already pretty much maxed out on how much money I can potentially make on my credit spread. And remember, I would have taken profits even earlier here, right? Because at $80, you know, 2 contracts of that, I would have basically made $160 and taken profits. Versus the debit spread here, I'm up $276 and I'm still not near my take profit levels. I'm looking for some more upside. So I'm expecting that this number is actually going to continue to expand a little, especially if I can get back up to that $60, $63, $64 level. I'm looking at potentially $500, $600 worth of reward, versus here, I'm basically capped at about 160, maybe 250, even if I held it a little longer, versus here, I'm looking at more than double that on the debit spread. So you really have to factor into what your views are on that underlying stock before you decide which strategy you're going to trade. Elizabeth is saying, does Interactive Brokers offer OCO orders? Now, Elizabeth, my belief is that they do, and I've looked at their documentation to say that they do. But I will have Steve Sosnick on, who's the chief strategist of Interactive Brokers, on March 30th. So that's coming up in less than 3 weeks or so. Please, I hope that you're able to join us for that session as well. We're going to be talking about futures on that topic as well. And we're going to ask him about OCO orders. Can we place OCO orders in Tastyworks? This is where I've gotten some feedback that you cannot trade OCO orders in Tastyworks on spreads. I definitely trade a lot more on Thinkorswim than I do on Tastyworks, but I was actually planning on testing that on Tastyworks to see if you can trade that OCO order on Tastyworks. Today's spread on Zoom, can you comment? I would say my spread on Zoom is very similar to my trade on Facebook. As you can see, it recently broke below some major support levels here around 360 or so. It's come all the way back to retest this level as resistance. And I think that from just a risk to reward perspective, it favors on the short side. You know, I really go back to the valuations here and the higher interest rates that we're starting to see. It's very, very hard to justify these valuations, especially as revenue growth here slows down here for Zoom. You know, they've quadrupled their revenues in the past year, but the quarter over quarter revenue has slowed down substantially. And I expect next month and next quarter to also slow down. And it broke below the 200-day moving average recently. It broke below all of these levels. I'm just simply seeing if I'm taking a bit of a, I would say, speculative short here on some of these high flying tech names. So that's the rationale behind the short Zoom trade. Irina, on your question about your spider butterfly, if you don't mind, send me an email at info@optionsplay.com. It's just too much for me to try to figure that out and what you're asking at the moment. And if you actively want to trade futures, please join us next Wednesday for me and Tom. We're going to talk about the new futures products that you can trade at Small Exchange. It'll be at 4:15 p.m. on Wednesday. So you'll receive an email from us tomorrow on that session. If you're looking to see, you know, the open daily trades versus a portfolio, click on the link at the bottom of the email that we send you every single day. That'll show you all the closed trades and that will show you all the current open trades. Joe, I'm not sure I understand your question about what you mean by grabbing the bottom of the underlying. I'm not sure I understand that question. How to set up an OCO order for an iron condor? You would do it the same way as the video showed you, because you just use Thinkorswim to select your positions. I don't know that I have any positions here right now. Yeah, I don't have any positions in my test account or my practice account here. But you select your positions, you go to a closing order, and then you would use the same functionality of duplicating orders and using the advanced OCO order to close it. Doesn't matter what type of option order, the process for setting up an OCO order is the same regardless of what type of position you currently have. And I got a lot of questions from people asking me about lows. Keep in mind, there's LOW and there's LOWE. That we did not trade LOWE. I'm not sure how people, you know, I just want to make sure people was trading LOW, not LOWE. Frank, FCX, yes. I will say FCX has been the trade that keeps paying us this year. We've been in this trade 3 times. Each trade has been very nice. Looking forward to taking profits on that particular trade. What's your view about closing one leg at a time on a spread? I highly, highly recommend that you do not break out a spread from each other. Trade them as a spread, enter and exit them as a spread. Do not exit them one by one, because if you do, hoping that you're going to be able to eke out an extra few dollars or a few cents in gains, you can potentially lose a lot more than what you can potentially gain by breaking a spread apart. I've seen it too many times. I do not recommend investors to break apart a spread. On Thinkorswim, setting an auto profit taking on short puts, would you set a stop loss order since you're looking for the price of the option to drop to a certain price to buy the stock? So Jameson, I would say that short puts are really one of the few strategies that if you want to acquire the stock, doesn't make sense to put in a stop loss. It doesn't really make sense to put in a take profit either, because if you're taking profits on sorry, I take that back. You can take profits on a short put because that means the stock is moving higher and you might want to roll your puts, but you're correct. You may not want to set a stop loss on a short put. On options play under profile, can we change the income setting? You don't have to go to profile to change your income settings. You can go to income and there's a button here at the bottom that says income settings. You can click on that. That will allow you to change your settings. So you don't have to go to your profile in order to do that. The risk of letting credit spreads go to expiration is chances that we might lose any profits made. If you continue to be bullish on the stock and has moved up a lot higher, I'd still recommend close at 50%. Yes, you do not want to hold the credit spread to, well, I take that back. You can hold it to expiration. You're just, what we're going to see is that about half the time you're going to make the other 100%, and the other half the time you're going to lose what you've gained on the credit spread. And so it comes out at the end of the day almost the same at the end of the day, whether you hold it to expiration or not. It's just that most people prefer winning more often, even if they're winning smaller amounts, rather than constantly going through these swings of making almost 100% gain on the trade and then losing 100% on the trade, because in that last few days, what tends to happen is exactly what I showed you in Tesla. If you were on the short side of that Tesla trade, you would have been, so for example, if you were on the other side of that Tesla trade, and you thought you were making money, you had a 99% chance of winning. Basically, if you were on the short side of this trade, you would have said, oh, you know what? I look like this is going to be great. I have a 99% chance I'm going to make everything. And one day later, you lose everything. So we see this a lot with credit spreads that you hold to expiration, where as you get closer and closer to expiration, especially if the strike prices are near the strike, the stock is near the short strike, is you think you're making 99, 95% of your max gain. And all it takes is one bad day, 2 to 3 days from expiration, and all of a sudden you're down the whole spread. So, at the end of the day, it kind of becomes even whether you hold it to expiration or not. But most people don't want to go through that kind of emotional pain, if you will, of seeing 80, 90, 95, 99% gain, and all of a sudden to see that wiped out in the last 2 days. So that's why we always take profits at 50% gain and 21 days to expiration. Okay, with that covers the questions that I have time for here today. Thank you so much for your time. I hope that this was helpful in giving you a better understanding as to how to navigate the OptionsPlay platform, how to maybe take a look at the Thinkorswim platform and sign up for an account if you're interested in the Thinkorswim platform using the link here on your screen. I'll post this link into the recording as well, along with the slides for those of you that want to follow along. And thank you so much for all of your support here for OptionsPlay. For those of you that are members, you're going to be invited tomorrow morning for our rapid fire session. That's where I take a look at the symbols that you guys submit. I'm really looking forward to getting back into that because I really enjoy doing those rapid fire sessions tomorrow morning at 8:30 a.m. And for those of you that are on a free trial to support us, just becoming a member is only $75 a month or $500 a year. You can go to trade.optionsplay.com/member. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here tomorrow morning.